When do we start to focus on the fact that there is no growth in Europe? It's just an absence of a recession, and what we've seen so far is a bit of a squeeze, a relief rally, and perhaps nothing else?
Well, I think we need to put it in context here. We think that the global economy is in a relatively good shape, and we expect to see a soft landing in the US, but we also now expect to see a relatively soft landing in Europe. The falls in gas prices have helped, the pickup in China as well. But the absence of recession, as you say, doesn't mean we're yet into a strong recovery cycle. And I think the rebound that we've seen in risk assets in the last couple of months is overstating the potential from here at the index level. We've got flat returns in the US this year, slightly positive returns in Europe, so we prefer Europe. We think most of the action is going to be below the surface of the index.
Well, let's talk about those opportunities. Banks have ripped in Europe. They're up about 50% from the July lows. I picked out a minor because I know you like some of those names as well. Rio since October's up something like 40%. These are huge monster moves, and credit to you guys because you got on board this banks trade in Europe at a time where I was sitting there thinking, you've got to be kidding me. We're going to get rate hikes from the ECB. It's going to crush the economy and peripheral spreads are going to blow out all over again. Why has that trade worked, and why do you think it will continue to work?
Well, I think there are three things. First of all, the recession that people feared 6 months ago is not happening. There was a point where the market was pricing in quite a big downturn in the European economy. The expectations there are adjusting pretty quickly. We actually have 0.6% GDP growth across the Eurozone this year. So the economy is growing, not shrinking. That helps a lot. Second of all, the rise in interest rates we're seeing is material, given where they came from. Remember, just a year and a half ago, 25% of all government debt in the world had a negative yield. Now that doesn't exist. European rates were negative. Now they're positive. The leverage to that in terms of net interest margins is the real game changer. And bear in mind that corporate balance sheets are reasonably healthy. So loan losses and the risk of a big downturn hitting banks is just evaporating.